Good morning, ladies and gentlemen. My name is David Whittaker. For the next 25 minutes or so, I'm going to talk about funding opportunities in the buy-to-let market. And you can see I'm smiling a bit because the market's improving, so perhaps I've got some positive news for you all. Obviously, it won't be quite the news you'd like to get, but it's certainly better than anything I could have told you 12 months ago. Gentleman in the back, can you hear me all right? So I'd rather do without a microphone, but if my voice doesn't get to you, just shove your hand up and I'll shout loud or pick up the microphone. I've just been given a toy to play with, so the presentation will now probably drop off the screen and I'll get it hopelessly wrong. But what I hope to get to this morning is where the market was in 2007, those happy days where every lender gave you money, preferably they took a charge on profit, often they didn't. Where it went in 2009, how grim it was, and then the slow journey back to where we are today. What's influencing the market? I'm never an apologist for the banks. We've got any bankers in the room? Good. I'm never an apologist for the banks, but if you understand some of the restraints that are placed on them, whilst I don't expect you to sympathise with their position, you might at least empathise with it and understand why it is difficult to get money at the moment. We could talk about Greek sovereign debt and the 21% write-down, and what's the fact affecting this country. And then where we think we are today, because when we've been speaking to landlords over the last 6 months, a lot of you remember where it was in 2009, 2010. So tell you what the lenders are up to today, and perhaps where we think one or two might go in the next 6 to 12 months, which might encourage you to feel a bit more positive about the state of life. And because all presentations should have bits in it that are complicated, I gave it with a couple of swap rate graphs. That's what fixed rates become, and fixed rates should be something we will be thinking about for the next year or so. And then I'll talk a bit about the technology we can bring to play with you to help you make the right decisions. If at the end you want to throw in any general questions, I'll be very happy to take them. Actually, I'm not the best person to talk to, I'm just the guy standing up. Around the corner on stand R5, literally just around there, I've 2 or 3 of my colleagues who are right up to date with the market. They know the rates, they know the terms, they'll know what lenders will do. By all means, I'll take your questions, but I'll probably bluff it. They'll give you the right answers. So, without any more ado, we've been around a hell of a long time, which is why I'm either mostly bald or mostly grey. We're specialist brokers in the prime buy-to-let market, we do commercial mortgages as well. We're obviously down in London today, so we cover this session from our offices in Sevenoaks, but we also have offices outside Manchester and Wilmslow, where we have a team there that will cover the northern half of the country. Back in the good times of the market, pre-2007, we ran a company with 4 other brokers where we aggregated our business volumes to get exclusive products for you, and we are now back in that situation again today. Actually, in this room you're all consenting adults, you're all working in the business environment, so you do not enjoy the same protection on your mortgage advice as you would do for your homeowner mortgage. So if you have an unfortunate outcome with a lender or a broker, on a buy-to-let mortgage, you can't go trotting off the Financial Services Authority. You are in the business arena, so you're not protected. That said, we are members of a trade body, very boring, National Association of Commercial Finance Brokers. If I or my team let you down, you can complain to my trade body, and they can actually take away my ability to trade. But having said the downside, occasionally people like what we do. We picked up a couple of awards this year. Perhaps the significant one, or significant from my viewpoint, What Mortgage Awards, which is a public magazine available in W.H. Smith or other retail news agents. Voted as Best Specialist Advisor in July in terms of the advice we give to professional landlords, and hopefully today we can continue that movement. Let's go back to those halcyon days, 2007. Wasn't it marvellous? There were over 15 mainstream lenders. We say there were 600 products out there. Actually, it was nearer 2,000, but you can forget about 1,400 of them because they weren't any good. But there was plenty of choice for you as landlords. And whether you were buying a new build, you had an HMO, you were refurbishing it, you were a professional landlord, or you did the whole jolly thing in a limited company, you had choice. And with choice came competition as lenders fought to gain your business, and the pricing went through the floor. And the loan to values went through the roof. Most of the market was at 85%, and the stress test worked all right. 1 or 2 lenders went to 90%, but frankly, when you looked at the pricing of the products and the stress tests, it just wasn't worth it. So 98% of all mortgages got done at 85% or below. This was the bit you all liked, that funding was given away, 1 1/4 over base, or over LIBOR. which at that point in time, and sovereign debt is something we all know a bit more about now, sovereign debt for someone like Germany was 0.8%. We were paying a bit more, the Greeks were paying probably about that. I'll come back to that in a moment, because actually consumer debt today is cheaper than sovereign debt, and that's something we need to appreciate. And what was really nice, that when you came off the initial offering from the lender, your back book rate, your reversion rate was 1 3/4 to 2 1/4 over cost of funds, and with base rates stuck at 0.5%, you're typically paying 2 1/4 to 2 3/4% on your mortgage. Has anyone got a Mortgage Express mortgage in the room? Anyone? Well, there's about 3 or 4 of you. The rest of us, we collectively own your mortgage, sir, as indeed you own it yourself, because Mortgage Express, part of Bradford and Bingley, went down the tubes, taken over by the Treasury, now called UK Asset Resolution, and at 1 3/4 over base, there's 239,000 buy-to-let customers who are going nowhere fast. Why would you move away from that product if you didn't have to? Unless, of course, you want to get money out of the property. Of course, they're not lending any more money, so they, along with the likes of Paragon, CHL Mortgages, because they're owned by Irish Permanent, and various investment bank funded mortgage companies were the first out of the market in 2007 and 2008. And I guess there'll be some of you in the room who had mortgage offers out there, which you hoped to complete, and all of a sudden the lender walked away from you, you were a little bit embarrassed. But that's what happens in the credit crunch. What was particularly interesting, that you guys collectively accounted for 12.5% of all mortgages in that year, a figure of £42 billion, which if you consider that the buy-to-let brand, as put together and copyrighted by Arla, was only put together 11 years before that, to get to 12.5% of the UK mortgage market was an incredible achievement. And even better than that, you, with the support of your tenants, paid your mortgages. In fact, you paid your mortgages much better than the average homeowner. The arrears on your mortgages are less than half of the arrears on prime domestic mortgages. Might have changed a bit since then, we can talk about that. But going into the recession, buy-to-let mortgages were the most attractive mortgages for lenders in the securitisation markets. And therein lay the problem. We'll get through the painful bit quickly, but the trough of the market was 2009, and probably, I'll say May 2009, when I took a call from a journalist from the FT who said, running your product system, how many products are you running? Less than 100, actually it was 93 products. So you've gone from 600 products down to 93. You've gone from 15 mainstream lenders down to 2 mainstream lenders. The Mortgage Works, out of Nationwide, and BM Solutions, then out of HBOS, now Lloyds Banking Group. We can discuss that endlessly. Those 2 mainstream lenders still control the market to this day. And of course, what you guys found was that they wouldn't lend on your limited company any longer. Your credit profile had to be so squeaky clean, it had to be better than George Soros. And if your property was anything other than a 3-bedroom house or a 2-bedroom flat, they didn't want to know. So effectively, they pulled the horns in every single direction. And then to add insult to injury, they dropped the loan to values to 75% at best, often lower than that, and in general place limits of £1 million on you. There'll be plenty of you guys in the room who've got much more than that with one single lender. Let me just say at this point, this presentation is available on our website from tomorrow.
From Friday.
From Friday on our website. And if you let Jenny and our team have your email address after this presentation, we'll just email it through to you if you suffer from insomnia or want something to read before you go to bed at night. Just to finish off the final insult to injury, your pricing margins that had been 1 1/4 over cost of funds, perhaps 1 3/4 on reversion, were up to 3.5 to 4.5 over the cost of money, and the lenders were helping themselves to rather handsome fees at the front door. Because they could, because there was no competition. So that was the bad time, mid-2009. And by the end of that year, thankfully, we started to see a gradual change. Oh, before we get there, we'll just talk about the numbers. This is how it went. Remember I said back in 2007, you guys accounted for 12.5% of the market. There you are, a whopping £44.6 billion. Actually, that's only £10 billion more than you guys and me pumped into Lloyds Banking Group and RBS to stop them going down the tubes. But here you can see as it came down to 27 billion, 8.5 billion in 2009. Yeah, mathematicians, 20% of that figure. Mortgage market generally received by 60%, your sector received by over 80%. And in 2009, hallelujah, it went up. by £500 million. So what was driving it all? And in every presentation should have a graph that confuses you and confuses me. But this just tells you the shape of the mortgage market. The important bit is, what does it take to create a stable mortgage market? And this green bar chart shows you the Council of Mortgage Lenders, which is the body that collects all the data from residential mortgage lenders. It's not a statutory body, it's a membership body, so it can say what it likes. It's not governed by politicians or bankers. The Council of Mortgage Lenders says the UK mortgage market, to be stable, needs £200 billion of new funding each year at the minimum. In actual fact, it needs to be a little bit more than that, and this is what they said that they need next year. That figure is going to be shortly revised downwards, because I'll talk about this year's figures in a moment. But what you can immediately see is that as we came down, we've been well short of that, and the best prediction for this year from them is about 130 to 135 billion, which is down from last year. So you might say, why is the buy-to-let market getting better? Well, quite simply, this is the overall residential mortgage market, including homeowner mortgages and buy-to-let. So the buy-to-let piece is coming up, but the residential mortgage market in the main is still receding and still declining, because there are structural problems out there. Back in 2008, late 2008, the Governor of the Bank of England, Mervyn King, swerving Mervyn, stepped into the banks and created something called the SLS, the Special Liquidity Scheme. And he pumped in 212 billion into the mortgage companies and the banks, those that shouted loudest, who had the most reputational risks of the big banks and the big mortgage companies, and he lent them 3-year money. And in a normal market, you say, well, 3 years, no problem, we'll get out of it in the 3 years, and we'll refinance it. Well, of course, the covenant of the Bank of England and the covenant of UK PLC has shrunk, and therefore, he's made it quite clear he wants his money back. He's not going to roll these loans over. So just at the time that the bank's having to restructure and conform to new European rules, Mervyn needs his money back. And he said to the boys, you've got 3 years to pay it back. And so the expectation was that quite a lot of it would come back this year, and the rump of it next year. What the banks have actually done is they've done rights issues, they've called in loans, they've done all sorts of things, and they've got about half the money back in last year. And the expectation is most of it will be back in this year, with just a little bit in 2012. So the banks are ahead of the game, but it does mean there's been less money available for you and I to borrow. So I'm not apologising for the banks, I'm just saying that's where they're at. And this is where the good old British spirit comes to the fore. The European Union writes a set of rules that's called Basel III. There's never any intention by the Italians to adhere to it, even if they could. The Greeks couldn't, the Portuguese can't, the Irish can't, and the Germans and the French sat down and the rule excluded us and said, yeah, we're not going to accede to these new rules of capital adequacy, so we're going to defer it for 3 years. So which country is the only bunch of muppets and say they'll put more capital to one side for new banking regulations? You guessed it, the United Kingdom. So we put our bankers' hands up behind their backs and we require them to hold more capital against our mortgages. So just at the time we need our banks to be lending more, they're having to put more money aside on their balance sheets. So the game ain't yet over. It is not a guarantee that you won't see another Lehman-type situation somewhere in Europe. Hopefully it should be our banks, so they put money to one side, but there's still a pretty good chance a Greek bank could go down, even one of the French banks could go down. And that does matter, because our banks have lent them all money. And if they don't get the money back, it impacts the amount of money they can lend you and I. So, for you guys to be active in the market, you've got to be confident, you've got to have liquidity available, and there's got to be availability of stock. A recession normally benefits you guys because you wait for the repossessions to come in, and you speak to the local estate agency, and you knock down properties out of his windows in 2 weeks' notice, and you get them on the cheap. But actually, the number of repossessions hasn't even reached 60,000 last year, where the expectation was over 100,000. So you're not getting the number of turnover properties from repossessions that the market would expect. More importantly, new build activity. Who remembers John Prescott, Deputy Prime Minister? He guaranteed that their government would deliver 200,000 units a year for 10 years. The nearest he got to it was 80,000 in 1 year. Last year, they got to 60,000. So, new build, there isn't a lot coming out of the pipe. The new homes builders haven't got the liquidity to build that they used to have, and the small builders who actually account for more house units than the big builders, they haven't got the funding from the banks either. Of course, you guys, you always used to get your deposits for your next properties by re-gearing your portfolios, and if you can't borrow 85% and your property values are static, you had to find cash to do it. And I don't know if any of you in the room are people that do HMOs or freehold blocks. Certainly, all of this area has been difficult to fund for the last 3 years. And there is one final special interest group, I don't know if any of you guys are in this, who actually trade with the banks and have refurbishment facilities and buy properties in, convert them, refurb them and sell them on. If any of you have got facilities with the word Irish in it, Allied Irish, Anglo-Irish, Bank of Ireland, Irish Permanent, Irish Nationwide, well, they're all bust. All their loans have gone to something called NAMA, so all those loans have been called. And sadly, because we all own RBS, we own 83.5% of it, RBS are trying to call back £20 billion of money. And of course, you don't call 20 billion back from people who aren't paying their mortgages, you call it back from the people who can refinance. So currently they're calling up about 1,000 landlords a week and saying we want our money back. Not that the loans are wrong, but they need that capital back on their balance sheet to re-lend at higher margins. So there's a lot of movement going on out there. Some of it is good, some of it, if you're in this category, is very frustrating. But there is always a turning point in the market, and that was 2010 for sure. First thing that happened early on in the year, Mortgage Works, who had offered 70%, everyone thought, well, the next logical step is go to 75%, create discomfort for the lender at 75%, which was Birmingham Midshires or BM Solutions, but they let pass, they went straight to 80%. Now some of you might look at the product pricing and say, yeah, but 80% I'm not going to take it. But in terms of a market recovery, it was a strategic positioning that finally the market would go to 80% again. Also, to help warm up the pot, 2 new lenders emerged in the market, Precise Mortgages, brand new company, and All the More Mortgages, not to be confused with All the More Bank, who are a commercial bank, and they're owned by the same organisation, but 2 distinctly different operations. They came out in May 2010. Both of them lending to 75%, because if you're new to the market, you're not going to start at 80%, you're going to come in at 75%. So you have the first start of a bit of competition coming in, a bit more product availability. And of course, the whole of the market, not necessarily you and I, but the city were waiting for the only FTSE listed bank that wasn't losing tens of billions of pounds a year, Paragon. They were waiting for the return of Paragon to the market. Paragon went out early because they were wholesale funded, but they formally returned to the market on the 28th of September last year, quite quietly, rather limited distribution, restricted underwriter access, and the paperwork is like knocking down a rainforest, but they were the first lender back into the professional landlord space, offering 75% with 2, 3 and 5 year fixed terms. So it was important to see Paragon back. It sends a number of messages to the city about looking at funding again, and for the professional landlord, finally some capacity for HMOs and also for limited companies. These are all necessary building blocks for a recovery of the market. And then subsequent to that, early this year, Paragon owned a brand also called Mortgage Trust. I don't know if you've got Mortgage Trust mortgage in the room, but they relaunched that back as an online offering through intermediaries only in April of this year. So there all of a sudden, you've got one of the big beasts back in the market, lending some money. It doesn't matter how much at the stage, but the main thing is you're getting lenders back in the market and the re-emergence of competition. Which you might say, well fine, how does that affect me? When am I going to start getting some better mortgages, some cheaper mortgages and things that I want? And here's a simple answer. If you go back to almost exactly this time last year, 6th of September, through our central tracking system, you remember I said there were 600 mortgage products, it went down to less than 100. By September last year, we were back up to 200. These are spikes as lenders withdraw products and push them back out again virtually the following day. We could probably take them out, but you can see there's a remorseless upward trend, and here we are. It's sort of only crept up gradually over the last few months, but we are now batting in the range of 450 to 500 products again. Now there's one particular lender that has a suite of 80 products, which sends my technical department mad when they change an interest rate or their end dates. So you might say it's not truly 500 products, But the overall trend is what's important, that when you've gone from having 200 products to 450 to 500 products, it means competition, it means improving criteria, it means improving pricing for you guys. Let's just put the bold numbers up on the screen so you can actually see it in full figures. January 2010, 10 lenders. By January this year, 19 lenders. And by the time we got to the beginning of this month, it had left up to 23 lenders. And as I showed on that graph earlier, the number of products has just grown remorselessly over that same period. So far this year, I'd be surprised if you know these names, but I'll tell you what they do, because it's interesting in respect of what they're doing to change the market. KRBS is what used to be called Kent Reliance Building Society, is now called Kent Reliance Banking Services. It's actually now owned by an American investment house, the same guys who went after Northern Rock. And what they've decided to do is they can't compete with the big guys, so what they're going to do is they're going to support professional landlords with small HMOs, freehold blocks, limited company applications. So they're covering a segment of the market where there's a lack of competition. Accord Mortgages was owned by Chelsea. Chelsea got taken over, they merged with the Yorkshire. Well, that's they decided to take it over, offended sensibilities. But Accord are now part of Yorkshire, and Yorkshire Building Society were so far behind the race for the credit products they didn't lend on any buy-to-let, but they've recognised that they ought to be in it this time round. So literally 2 weeks ago, they launched a range of products for what I call vanilla buy-to-let mortgages, so nothing esoteric, but for standard Mr. Smith or Mrs. Smith buying a 3-bedroom house. And what they're doing is they're getting fixed rate money, and they're offering 65% and 75% mortgages. And I think it's on the Best Buy sheet that should be in the bags on your chairs. If you haven't got them, we've got all bags for you to take home afterwards. What's particularly important is this is an organisation that when they wake up, either finish bedding in their systems, they'll earn 50, 60 million pounds a month. And if you think that's pull up to £500 million a year, 650 million pounds a year, in a market that's only spending over 10 or 11 billion pounds, that makes them a significant player and puts pressure on other people to improve their pricing. And what we've already seen is over the last 4 months, pricing has generally come down from the lenders by about 0.3 to 0.45%. And you'll say, yeah, well, it's got another 2% to go, but you have to start somewhere, and the pricing is slowly moving in your favour. The final big one to watch this year is Abbey for intermediaries, Santander, Abbey Mortgages. I don't know what they call themselves, they keep on changing their names, but effectively this is another beast in the block. You know, Santander is a big, big brand, and when they decide to eventually get off their bottoms and get into the market, because they weren't meant to be here in Q2, they'll be the same as Accord. They'll come in and they'll throw in 50, 60 million pounds a month. And that starts to inflate the market in terms of product availability for you guys. Just to illustrate, there is one lender out there doing 85%. They launched in February this year, that's Kensington Mortgages. But the one thing that is changed in the market today is if you were to borrow 85%, you are going to pay a price for it. Buy-to-let mortgages are now priced on risk, just like commercial mortgages are. So if you're going to borrow 60% on a property, you'd expect to get a product in the range for 4.5%. If you're going to borrow 75%, you're going to expect to pay 550%. So if you want to borrow 85%, there's a bigger risk to the lender. They're going to charge you for it, and you're going to pay for it not only in fee, but in terms of interest rate. Is it greedy? You might say so. The reality is, under these Basel III rules, the bits that our banks have signed up to, but no one else is currently imputing, when you get above a certain loan to value, the new rules require you to put more capital to one side in case that loan defaults. So from a bank perspective, it's not just the risk of the loan going wrong, more of their capital disproportionately has to be set to one side when they lend to this level. So if they're going to lend to you, they're going to push the margin up quite handsomely to get the right rate of return on their capital. But here's the better news. Margins are coming down, and generally, if I'd given this presentation 6 months ago, that would have been at about 3.25%, 3.5%. Some products now are coming down into this zone. It's It's still 1% more than you're used to paying, but it's still a darn sight better than a year and a half ago. And the thorny subject of fees, i.e. the bit that the lender takes on the day of completion, and you either pay in cash or add to the loan, that is now coming down. We've got products available at 1%, and indeed there is one lender out there, and I don't think we've got anything new off them this week, Godiva, which comes out of Coventry Building Society, who take great delight in coming into the mortgage market with £100 million to go on a drop-dead product, gorgeous product. It's quite difficult to qualify for it, and they'll extract £100 million worth of mortgages out of the market, process them, and then come back 8 to 10 weeks later. It irritates the hell out of the marketing departments of all the other lenders who've got their business plan to run for 12 months, every month so much business. Someone like Godiva comes in, kills the market for 4 weeks, extracts 100 million, and it keeps the rest of them on their toes. So I'm all in favour of it. But I don't think they've got anything particularly cute out there today, but if you're on our database, you can get the details of any new products coming out. But most importantly, here we are in 2011, and finally, we've got 5 lenders that will do HMOs. At one point, there were none. There are also those same 5 lenders that will do limited company lending. You may not like the terms. Limited company lending is always more stringent and robustly assessed by the lenders than lending to you and I individually. And there is now some refurbishment capacity where you can go to one of these buy-to-let lenders and they'll do you a bit of light refurbishment and they won't charge you full commercial terms as you get out of a bank, if indeed your bank would do it today. And finally, lenders caught colds on new build. Finally, there's now more standard lending to 75% loan value on new build property. So it's a much changed position from 2 years ago, and you can see the trend is improving, and therefore it's more attractive for you. I popped up a graph earlier showing how the buy-to-let lending industry was going on a historic basis, and you might say, well, no surprises given what you just said, that the expectation for this year was £11 billion. But if you look at the bottom here, the first 2 quarters, first quarter was out at 2.9 billion, 3.5 billion was announced by capital mortgage lenders last week, so 3.5 on 2.9 is 6.4 billion. So already at the half-year point, they're already running at a far higher run rate than £11 billion a year. And the expectation is it might be as high as 13 or 14 billion, which all of a sudden becomes highly significant in relation to the residential mortgage market. It means that buy-to-let is back and it's counting for more than 10 or 11% of mortgages again. So you're back at parity in terms of percentages, now the volumes have got to lift up. And the reason why lenders are doing that is that when they lend to you and I in our own names on a standard 3-bedroom house as a buy-to-let proposition, it's the same risk weighting as lending to us on a homeowner mortgage. So if they get a higher return out of you and I on a buy-to-let, they'll take it every day. This is, of course, another graph that's designed to confuse me as much as it's you. This is how the banks trade their money between one another to make you and I fixed rate. So the lines I always look at is the nice green one, not because it's necessarily nice and bright, but that's 3-year money. So if a bank was borrowing money from another bank or creating a swap rate at 2.3% back in the beginning of March, add a margin to it, let's say 3.5%, you're looking at 3-year fixed rate products in the order of 5.7 to 5.99%. Here we are now, down as at the end of August, bring that line back across, and we're down at about 1.6, 1.7%. So what you will see, now that the lenders are all back from their holidays, because they do take holidays, quite a lot of them in actual fact, you should see some decent 3-year fixed rate products coming out shortly. And what we've got on the sheets there are looking better than they were looking 3 months ago, but there may be some good offerings out in the coming weeks as lenders jockey for position in the run-up to Christmas. Because like all of us, they have business targets. Most of them have a year end of 31st of December. Chief Executive's back from his 3 weeks down the Mediterranean on his yacht, and he's saying, Sales Director, we've got 14 weeks to get to the end of the year, and we're 400 million light on our lending targets. Get some product in. So what you'll see in the coming weeks is some good product coming out from lenders as they struggle and jockey for position between now and the year end. The only other one which Steve, who's on the stand, has asked me to bring to your attention because he thinks it's good, there's been a lack of 5-year money in the market. Lenders don't like doing it because if they've got to commit to it for 5 years, they've got a fixed margin on their books. 5-year money has come right down, and on those best buy tables, I'm not sure what the 5-year product is we're showing. So is he reaching for his glasses? 5 years. 4.79%, fixed for 5 years to 65%, or if you want 75%, you're going to pay an extra 0.2% to 4.99. It's got the right feel to it. Where it really works, and you know, I can get all my southern prejudice out here. We live in the part of the country where property values are quite high, so when you look at the lender fee, a flat lender fee starts to work in your favour, whereas someone from Lancashire would say £1,800 completion fee. You've got to be joking with that. If you're borrowing £300,000 at 4.99% fixed for 5 years, and your completion fee is 1,800 quid, that's about 0.5% or slightly over 0.5%. That starts to sound nice, providing it works for you, that your view is that base rates are going to stay low for another 12, perhaps 18 months, and then we're going to see inflation take off. You can't pump out 185 billion of quantitative easing out of the swamp and not expect it to come back as an inflationary pressure at some point on your radar. So sometime in the 5 years, 4.99, if you are risk averse, 4.99, 75% starts to look really cute. And let me remind you, ladies and gentlemen, sitting in this room, you're sitting here as business people. You make your decision and you call it wrong and rates don't go up. You can't go and punch the lender's lights out. You can't go and punch my lights out. You're making your own decisions. But we'll provide you with the evidence all day long. We'll get involved in a robust debate. Like a ball for England and so to Societe Generale writing down the Greek sovereign debt by 21%. Because they were the guys that called the financial crisis in August 2007. Chairman Sokchen came back from a rather boozy Gallup lunch and put out a rather loose announcement saying, we're a bit worried about our RMBS, which is residential mortgage-backed securities in the United States. Excuse my French, ladies and gentlemen. He said in sort of Gallup style, frankly, they're proper shit. We pulled back a couple of layers and we're all in trouble. We're getting a provision for these, at which point every other bank had to lift up the drains and go, whoops, we've got a problem. So Societe Generale, they may get many things wrong, because after all they are a French bank, but they called stage 1 of the financial credit crisis right, and they've been the first bank to write down sovereign debt. And after talking about sovereign debt, I said about consumer debt, if we assume that you and I are going to pay 3% over cost of funds for our buy-to-let mortgages, but Greece is paying 6.8%, heading towards 8.5%, and Spain's at 5.6%, the banks at some point are going to say, hold on, this is daft. So there's going to be some tension management over the next year or so as people get their heads around that consumer debt is cheaper than sovereign debt. It's not the way the world runs itself, so there are still issues out there. But anyway, to go back to this graph, 5-year money is what Steve, my colleague on the stand, is very keen on. That's the purple line. You can tell he's wrong and say, I think base rates are going to remain low. So on those best buy sheets, we've also got some tracker rates, where if you think the rates are going to stay low, you can take 2-year money and enjoy a low base rate and keep your pay rate down as low as something in the 4%. It's your choice, it's your call, but we'll provide you information, you make judgments. And indeed, to help you make judgments, we have a fully web-enabled sourcing system. It's the only one on the market. We make it available to our own staff and about 20 other brokers. Actually, we embed it in the marketing department of those 15 lenders I mentioned earlier, because I believe that the more intelligence they have about what their competitors are doing, the more likely they are to come out with better offerings. And of course, what they say to me is, well, I like it, I don't want all the other lenders to have it. And I say, well, I may be stupid, but I'm not that naive. The deal is, if you put data into our system, I'll make it available to any other lender that contributes data to our system. And it is for the greater good, because actually, it cuts out all the rubbish and we get to the point where lender products start to make sense. From that, we can produce illustrations for you all day long, electronically. You give me a set of figures, we'll give the guys a set of figures, we can bang it out your email address within two minutes. What we've done, and I think the first version that will come up, is the system that my guys have got. Immensely complicated, but there's nothing you can't tell me about the property that we can't plug into the system. If, for example, you've got different sorts of tenancy arrangements. Have you got a single AST to a family? Have you got 5 students on one AST? Or have you got 5 students in your property on 5 separate ASTs? Is it now, because you're in Islington, deemed to be an HMO and it's 5 bedrooms, when actually in every other borough in London it's deemed to be 6 bedrooms? It's all in there in the back office system. And if you remember, I said we had 450 to 500 products. Hopefully by the time you answered our questions on the phone, and it keeps on knocking down the search criteria, we end up with more than one product left of it. So we've got some choice of you. But it will get to the right answer every time as to what is available to you in your circumstance. Well, what we've done as a trial, and we welcome your comments, we've put a cut-down version of this onto our website. What it has is the power of that other system right behind it, so all the products are up to date, and you can put in your own details at the top, property value, loan amount, rent per month, and what sort of product you want. You want all products, fixed rates, discount rates, and it will work out all the maths for you. It'll tell you if you want to borrow a certain loan amount, what the required rent is, just in case you don't achieve your actual rent and the value goes in. That's the minimum rent needed to achieve that loan amount, and it will give you the lender fees, the APR, and all the product details, and you can press on that button and it pops up in our office. We can have a debate with you on it. We are going to enhance this in the coming months to give you more detail, but essentially you can play with this all day long, out of hours, midnight, 2 o'clock in the morning, and if you want help, just ring our office from 7 o'clock in the morning. There's always someone to talk to you about it. Now, the presentation we've done today is available on our website from Friday. You can also have it as an email if you give us your address afterwards. But in the plastic bag on your chair, if you haven't got one, pick up one on the way out. It is the best prices. We see them this week in the market, and they'll change from week to week. We update them every Friday morning, so if you want to receive regular updates from us on products, just let us have your email address. And we produce a quarterly newsletter which embraces not just the vanilla advice, but also commercial property, what's going on in the property market generally, because you should always make your judgments in view of as much information as possible. And we now produce something called our buy-to-let index. You can go to the Council Mortgage Lenders website, and they produce a quarterly index, and that's just on vanilla property. We expand that to include freehold plots and HMO properties as well. So for those of you who've got property in that area, you'll see the average yields, average loan amounts, average property values, and every transaction we discuss with people goes into a massive database in which we provide the report free of charge, because you are business people, in order to make business decisions you want information. All that information is available from our databases just by logging in and getting your name into our database. Ladies and gentlemen, I said it'll be 25 minutes, I hope I kept the time scale. If anyone wants to throw me a question, by all means do. My colleagues are on standby around the corner, and we'll happily take the more technical questions so you can trip me up very quickly. But thank you for your time.